I'm staying away from technology. I'm staying away from things that are crowded. I'm staying away from especially sovereign debt as well, and I'm staying away from long duration assets. What I'm focused on is, in particular, natural resource industries. I am trying to be as niche as possible in the space. I think that there is going to be tremendous opportunities to make explanation returns in a space over time. And so I am mostly focused on metals and mining. That would be 70% of the allocation of the fund assets. My personal assets is even more than that.
So let's talk about that. So 71%, you mentioned this earlier, 71% of financial advisors hold 0 to 1% of their overall assets in gold and gold related assets. The average for all investors is less than 0.5%. The 5-decade mean, it's closer to 2 to 3%. And the high during the 2008 to 2011 GFC was like 8 to 9%. What's going to bring the Western investor back to gold? And do you see a reversion of the mean? It sounds like you see a reversion of the mean. So, what is going to bring the Western investor back to gold?
Well, so the Western, I think of the world in pools of capital, and also how they prioritize allocation of assets. If you think about institution, if you're talking about government institutions as the Western world definition, in terms of central banks and others, I would say that for them is just the fact that, if we start seeing more and more questions about a long-term inflationary problem and further disruptions in their monetary system, ultimately drives their focus back to gold, I think. But that's going to take some. It's going to be so meaningful when we hear that Western societies are disclosively buying gold. I mean, that would be a big shift in the narrative, in my opinion. It would be more towards the middle part of the cycle, in my opinion, that we're going to see something along those lines. And I could be wrong, and I'm happy to be wrong, but I think that that's what's going to be the case. Now, in terms of institutions that are not government related, that perhaps are more private and public company owned things, I would say that their prioritization is completely different. It tends to be risk, and what forces them back into the space to me is the fact that a continuation of a world where the correlations have changed relative to 30 years ago. And what I'm referring to is not only the correlation between U.S. equities and interest rates, where we had a world where falling interest rates have helped to inflate the financial assets valuations. If we see a shift of that world, which we started to see that in 2021, a lot of people saw that and said, hey, that's the new world. And then 2022, 2023, especially the middle part, end of part of 2022, we saw a flip of that view completely. And now we're, back to AI and all these other things. And that's normal. That's what markets will do to you. And none of us have the power over that. Now, and I do think that the real world would be more like the 2021 world, where interest rates do matter. The correlation of things have shifted. Gold can rise with interest rates rising. Markets will be penalized by higher cost of capital, which doesn't take a lot of brain power to come up with that. And value investing will probably return over growth. And the prioritization towards profitability will return as well. And what we're likely to see, which is something that has happened recently, that I think will become more and more, again, using that word, entrenched into the way people think about markets, will be as we see the continuation of gold being less volatile than treasuries. And that's key, because as people continue to see that, which, by the way, this is the first time in 45 years that we see gold actually being less volatile than the US treasuries. And so as we see the continuation of that pattern, which I think we will, then I believe that that people will start, flipping back to gold. And it's always important to remember, if central banks make a move, because they're so big and because they tend to create long-term trends as they buy something. And that's what we saw back in the early 80s with treasuries, when central banks started buying treasuries and other sovereign debt instruments, created a 30-year decline of interest rates. That's probably where we're facing here in terms of gold. Not that we're going to see 30 years of gold prices rising, but we could. We're probably going to see is the beginning of those central banks flipping back, and that ultimately drives institutions. Now, what was created during that period when central banks started buying treasuries was the 60/40s idea, the risk parity idea. All these things came after central banks did what they did. And I think people are not understanding that yet, that central banks lead the way, and then we see other things. And that's because they have the printing press, and then ultimately drives other decisions. And I think we're in the process of people starting to figure that out.
Yeah, that's a great overview right there, Tavi. The gold to silver ratio historical mean is around 50, and it's been between 80 and 90 for several years since the pandemic. Right now, it's in the mid 70s or thereabout. Tavi, is the gold to silver ratio outdated and irrelevant, or is it historically high and set for a mean reversion? And in your opinion, what is your silver thesis also?
It is outdated, and it's likely this time will be different. Of course not. I don't believe in that at all. I think that history played a role into conviction of ideas, and we always ultimately go back to what we saw in other times. And the fact that people have lost faith in the metal and believe that we may see a gold bull market, but silver won't participate is completely ludicrous and lacks research to support those views. It's the same thing with miners. You know, I'm watching people say, yeah, I do think gold is going to enter a bull market, but I don't think the miners will. When in history did that ever happen? I mean, if you know a little bit about history, especially silver, you will know when you enter a bull market for gold, the high beta of that would likely be silver. It has been in the past. It will probably be the same today. And the more important side of this is that silver is actually fitting more and more into this industrial growth that we're likely to see being forced by the reshoring, the green revolution, and other things, solar panels. And so, but remember, ultimately, silver is a monetary metal. And regardless of its functions in the global economy and the way it fits into as an aspect of being more industrial, it will also fit into in a big way as a monetary metal. And when I looked at things, especially in the silver world, I see that there are great opportunities to find leverage in silver prices through the mining industry. And that's why I've been so focused on that. And we recently acquired the 7th largest silver mine in the world. You don't do those things when silver is trading at $100 an ounce. You see those things when they're trading at $18. And what was trading at $18, you know how many people commented on charts and things that I posted on silver? It's going to go to 15. And who cares if it did, actually? It didn't, but who cares if it did? You should be taking advantage of that. Again, that's a great example of conviction versus stealing somebody else's thesis. Those guys changed their conviction immediately. That's not how you I think make big money. Big money is made on setting up that long-term strategy and deploying capital the most smart way, looking for asymmetry and so forth, and taking advantage of those big trends over time and not worrying about short-term movements unless it's through taking advantage of those short-term movements that are, offered as a discount for market participants. But, there's a reason where there's a few billionaires in the world. And, I'm definitely chasing that myself.
I really hope that those who are listening in are paying attention to the conviction aspect. It is not easy to hold when you see, mining equities drop 20, 30, 40%, whatever it is. It's not easy to go through that. However, as you've noted, it's the compounding interest that happens over time. And as the thesis plays out, there are people who have seen 100, 500, 1,000% gains. That's a whole lot different ball game than a 20 or 30 or 40% drop. And that does take conviction. So I do appreciate that. And I hope the folks are listening. Tavi, if the precious metals or when the precious metals are going to make the move that you suggest in the next 1 to 3 years, clearly sentiment in gold and silver is going to undergo a historical shift to the positive. They'll once again be in vogue. widely talked about, et cetera. Do you see that sentiment shift alone will create a rising tide raises all boats scenario for the miners, where anything that has gold or silver in the name is going to spike higher for a period of time?
Yeah, I can definitely see a speculative wave in this environment, which tends to be the case. And the reason why the M&A cycle has partially started, but not really, is because of share prices. When you start seeing the share prices of the majors going up, that's their currency. And when they see their currency going up, they start buying up other things. They're hungry. It's clearly they're hungry because they're making these decisions at ultra low valuations. Imagine what we're going to see at higher valuations. We're seeing some of the miners step in after their prices go up 20%. They're like, well, maybe I can now use my share price as a currency to buy this other project. Imagine if we see quadruple prices from here. What is that going to do to the M&A cycle? What is that going to do to small cap names? That's why when I see a price of a small company that we participate sometimes, and we go there and we buy the stock for whatever, we strike a deal at 15 cents. And we think that this company, probabilistic speaking, has the chance to be, a $1 billion asset one day. And we're buying this for nothing. Wow. Okay, well, then the stock goes down from 15 cents to 7 cents. Well, in percentage terms, that's a massive move. Now, in nominal terms, who cares? I should probably be averaging that down and probably buying a 7 cents so I can improve even more my average price. And as I see that happening, nobody steps into the illiquid market of junior miners to deploy hundreds of millions of dollars into the space because they're expecting a 30% move. No, we all want multi-bagger types of movements. I'm not here for a bagger. I'm here for a 10 bagger. And that's really where the capital will be made. And so the unicorns, there's going to be likely a lot of unicorns in this mining industry. But, it's shocking, like Snowline, putting out resources, an incredible story, 7 million ounces of gold, and, still trading sub $1 billion. Those things are just, if you research history about what the valuation of a mining company should be relative to how much value of mineral they have in the ground, that is just completely out of whack what we're seeing in that environment. And that's one example. There are plenty others in that situation.
So these mining companies seem to be confusing investors because they're expecting the breakout to, massive breakout to have happened already yesterday. What message would you give to the mining investors, both those who have stayed in and through the difficult times, and those who have already gotten out, been shaked out? What message would you give them based on the setup that you see, the historic macro environment, et cetera?
I think the message is always focus in owning high quality assets. Always focus in improving your learning curve in this space, because I think we'll be in high demand at some point. And the folks that really understand this market will be also in high demand as their skill set, because those folks that are waiting for a breakout to come in, they don't understand this market at all. They're just lost. They're just buying the futures market and so forth. They're going to make, nothing relative to the guys who really understand the space. And that's why there are billionaires that are created in this industry in every cycle. And I heard this guy speaking about the marketing idea of the industry, which I agree totally. It's like talking about, I'm personally bullish on Brazil. Now, do I think Brazil is going to become a developed economy? No, I don't think so. And I think once people start extrapolating that thesis towards that's the time to sell. And the same thing is going to happen with the mining space. The mining industry is always saved by their cycle. And, they're not going to, very unlikely, truly evolve as a marketing space and all sorts of things, because they're probably going to be saved by the price of the metal. And nothing will matter at that point. The only thing will matter is if they have gold or silver in their name. And, and that's a speculative environment we're probably going to see. And that's, ultimately we go there, and who survives are the real assets, are the ones that have high quality assets. And so you as an investor need to be chasing the real stuff. And so, spend time understanding that. I think that's the most important part of it, and take advantage of prices that obviously have declined relative to the intrinsic value of that business. And understand that the business of it, regardless of where we are in the stage of the mining industry, don't be surprised by an exploration company issuing shares. That's what they do. Or a developed company, basically saying that they're going to delay their project to be coming into production. That's usually happens. Tend to what I like to do, for instance, for developed companies, so forth. Read or production company, read their reports from 5 years ago. What their things that they were basically promising and seeing how difficult this industry is, and you will see that the shift in plans happen every quarter essentially. And that's a great way to understand management and management decision. And you can ask those questions then to them. Why did you guys say that? And then you did that, and see what the thinking was. I do that all the time. Most of the companies we invest, I usually look back and see, well, what are the changes the management did and why? So we understand the thinking, because ultimately the asset value will create the very rare cases where management will get on the way, but there are some cases, and you want to understand that risk as well very well.
That's great. You touched on energy earlier. Energy's been massively underinvested for more than a decade. Buffett has spent more than $100 billion investing in oil companies lately. Uranium's more than doubled in the last year. Countries around the world are pledging to triple or more their nuclear energy. Artificial intelligence is exploding. The data infrastructure that's needed is exploding. Even Microsoft and Amazon are investing into nuclear. Bill Gates started TerraPower, and a few days ago, he said he's prepared to invest billions into the nuclear energy space. What's your uranium thesis moving forward? And do you see this as a multi-decade play, or more of it's going to spike at some point and then drop like it has in the past?
No, I think it's going to establish itself as an industry, and also it's going to be a long-term trend, particularly when people start seeing the potential for generation of cash flow in these types of projects over time. And it is really the only game in town when it comes to sustainably creating an energy solution to all these supposedly climate change problems that some people claim we have. And so, and I do think that that's the only game in town. And I think the only difference and why I like so much the precious metals and other base metals, some base metals, not all of them, is there's a small difference between the two. It has to do with supply. There is enough supply of uranium out there, and it's not a supply story. It's really a demand story. So when I look at the other metals, and I know the uranium community will get mad at me, but that's the truth. If you look at silver, there's a demand and there's a supply story, a big one. And so I understand that the supply side of uranium is a political aspect, meaning allowing that supply to be used is a bigger question than finding the supply itself. Now, silver, for instance, as we know, it's just really hard to find silver discoveries. We know it's hard to find gold discoveries and so forth. And so knowing that ahead of time makes me, as an investor, you're always thinking about, if we're deploying long-term capital like that, you're certainly also considering these trends. And now it doesn't make the uranium trade not attractive. No, not at all. I mean, I think it's extremely attractive. I think it will establish itself as important as potentially even the oil industry or sector. And it could be quite big. And so, I would never bet against it. I think that's a very solid thesis behind the uranium case.
So natural resources, they're increasingly emerging as a geopolitical strategic asset for nations around the world. This move to a multipolar world from a primary U.S. hegemony that you've been talking about, and the exorbitant debt loads of the U.S. is carrying, that's affecting the purchasing power of the U.S. dollar. They seem to be the main driving forces. Do you expect this to be a trend for natural resources to continue for years to come? And how will it affect price, supply, and even nation relations in your analysis?
I think it's going to get messy. I think we're going to see relationships being built in the future. Co- Regions of the world that have been also neglected for a long time will reemerge as important parts of sources of natural resources. If you're curious about what I'm thinking, is South America is a place that probably will, reemerge, and especially because it is already with sort of selling to both sides, the Eastern societies and the Western societies, and will probably be playing a critical role into the space of providing materials to the world, and so that's one thing. I think additionally we're going to see, of course, we're going to see nationalization and other issues, because that's we saw that in the 70s. I mean, the wave of nationalization happened after the surging prices, but prices need to go a lot higher first, and we will see that. And it's sort of inevitable. But those things are unique to each project, and a lot of times unique to each country, and will be, and that's why it will require a lot of diversification to avoid those risks in your portfolio. Now, I do think that the fact that deglobalization is escalating will only increase the demand for those for metals and other commodities. And I think that there's going to be metals specifically that have not been seen as strategic. Oil has. Will certainly become part of that as well. And most likely agricultural commodities and other things. But understanding that metals have a longer cycle than agricultural commodities because of the nature of how supply is created and the difficulty of putting something into production relative to agricultural commodities, where you can see a shift in 1 to 3 years. And so that's really why. And so I tend to focus more on metals and mining because of that.
So this has been a fascinating discussion. I really appreciate the time you've spent. Before we wrap up here and I ask you, Tavi, our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every expert interview that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Tavi as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Tavi, in wrapping up our discussion, my final question is about portfolio positioning. Based on all we've discussed today and with your experience and your worldview as your backdrop, how are you positioning for the next 1 to 3 years? What assets do you like? What assets do you absolutely want to stay away from?
I'm staying away from technology. I'm staying away from things that are crowded. I'm staying away from especially sovereign debt as well, and I'm staying away from long duration assets. What I'm focused on is, in particular, natural resource industries. I am trying to be as niche as possible in the space. I think that there is going to be tremendous opportunities to make exponential returns in the space over time. And so I am mostly focused on metals and mining. That would be 70% of the allocation of the fund assets. My personal assets is even more than that. Now, I love energy. I love agricultural commodities. I think I will start personally deploying capital into emerging markets more, particularly in real estate, because I can see that the improvement of those economies will drive those markets a lot higher. But the funds are also invested in that, and I think that's a smart decision. Emerging markets, the ones that I focus on, the ones that have high exposure to natural resources themselves as an exporter, not an importer, and so that's a big shift. And so, and I also think there's going to be a lot of opportunities in currencies. I'm watching that closely because I think that we might see a depreciation of the dollar relative to some other currencies. In particular, the emerging markets ones that I just mentioned. Brazilian Brazilian real is one of them. Canadian dollar even I think are very contrarian opinions that could potentially work in this environment. And so I'm paying attention to those.
Interesting. I appreciate all of that. Tavi, thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and your ideas. It's been amazing to spend this time with you. Would you please share with the viewers any final thoughts that you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
No problem. Thanks for having me, Gary. And you can find my work in a lot of ways. You can find that on Twitter. At Tavi Costa is the handle. You can look that up and you can see a lot of charts and analysis that I do. You can also find on LinkedIn. Some folks like LinkedIn, and you can just search my name, Otavio or Tavi Costa. And then we do a Friday live on YouTube every Friday, in which we discuss the macro sort of update about on the week, and also the geologic reasons why we've made investments in certain companies. And so, if you're interested in learning more about that and how deep we go, I would highly suggest to watch that. And lastly, would be in the Crescat.net website, where not only has information about the funds that we manage, but also on the research pieces that we put out that are very in-depth and long. If you're looking for that sort of way of understanding our conviction and why we drove those decisions and opinions, I would highly suggest you to read those.
Yeah, I'm going to put all of that information up on the screen, and it's going to be in the description with links. So everybody, you go follow Tavi. He is a wealth of information, a wealth of knowledge. I have read most of his material over the last few years. It is very detailed, very rich, and yeah, everyone has to come up with their own thesis. But if you're in the natural resource space, if you're looking, if you believe in metals and miners, Tavi is the follow to have. Okay. I look forward to having you back on, Tavi. Thank you for being here with us, and everybody else, thank you for watching.
Thank you, Gary.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every expert interview that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.